All right, welcome back to China's financial markets, China's stock market analysis. I'm still trying to work out a name for this channel, a name for this weekly recap, but we're in our second episode and I'm glad we're back. We killed it last week. We had over 28 views. We broke YouTube and broke the internet and showed how much interest there is in China's stock market. I'm only kidding, but it was a good episode. I'm still trying to work out the format of this, how it's going to work. A little bit different to last week if you viewed in, of the many viewers that did view in. But let's get into it. A lot's happening in Chinese markets. Again, a week filled of news and headlines. We're going to cover the biggest ones there, give you my insight, my analysis, my opinion. But before we do that, let's just run through the disclaimer. The video and contents are provided for information purposes only, do not constitute recommendation to purchase or sell securities of any of the companies or investments herein described. It is not intended to amount to financial advice on which you should rely on. No representations, warranties, or guarantees. Basically, I try to keep it as factual as possible, but sometimes I'm wrong. Sometimes, I've got things incorrectly. And remember, everything I give you is my own personal advice. You might disagree, you might agree. Let me know in the comments section. We got a whopping 0 comments last week. But hey, you got to start somewhere. And I'm sure as we go along, we'll continue to build, a viewership. And we'll continue to build on this as we go along. As I said last week, I'm hoping that hopefully there's some popularity for this and for some interest for it. I'm sure there is. And as we do that, we'll get some more interviews, some people on the show, etc., and try to build this channel and build this community of people who are interested in what's happening in the world's second largest economy and still, in my opinion, the most important economy in the world. And I think you'll realize why I think that as you start to tune in more. If you haven't subscribed, hit that subscribe button or give it a like. All right, let's run through what we're going to talk about today. We're going to do a market wrap. Get a little bit of a new one, just cover some of the headlines during the week that we saw. I'm going to talk about China's white list and some of the fallout from Evergrande. A few more opinions or insight on what I believe the Evergrande ruling will do going forward. I'm just going to put my phone on airplane mode so it interrupts me. A title called Running Away. I'm going to talk about some of the movement away from Chinese equities into other asset classes by foreign investors and particularly by mainland investors. I was asked on a radio show, BFM radio in Malaysia, what's the problem here? And I said the problem was shoring up mainland investors, not foreign investors. I think that should be second. And I'll talk a little bit about that as we go along. Let's talk about this concept of China. Is China uninvestable? And I'm going to talk about why this concept has risen its head, why we continue to hear China is uninvestable, some of the reasons why there is an argument for that going forward. A little bit of specific company news. I'm going to talk about Geely, the EV car maker, and its launch of satellites. And Barber's earnings did drop last night. I'm going to try to get to that today. If I don't, I'll cover it next week. So I kind of film this in one big lot and then, do a little extra as we go. So I might get through it, I might not, just depending on how my day goes. I've had to film this a day earlier. I have some relatives from overseas. I'm going to take them to the beach here in Sydney, Australia. But let's get through it. All right, let's talk about the performance. A better week for the 5 days going back. Now, remember, we go from Friday to Friday. I don't cover Friday's performance. It's kind of like Friday to Thursday, which gives us 5 days. Friday, Monday, Tuesday, Wednesday, Thursday. But a much better week for Chinese markets. So the Hang Seng up 2.75. Big day on Wednesday. Big day on Tuesday. Kind of pulled back a little bit on Wednesday. And then I won't get Thursdays in this week. So it's a bit shorter, but it's been a very good week. 2.75 so far. Shenzhen Composite up 4.41. Shanghai Composite up 0.5%. So this is a 4 day, sorry. This is a 4 day. They shouldn't say it's 2 to 7th. So it's been a very good week for Chinese markets, particularly on Tuesday, which I'll cover now, which was on the 6th of Feb. We saw markets really have a big day. So 4% on the Hong Kong, Hang Seng Tech was up 6.7. As you can see, the Shanghai Composite 3.2, Shenzhen 5.1, and the Starboard, which is the equivalent of China's Nasdaq, 6.5. So a fairly good week and a fairly good day. A lot of analysts were saying signs of a bottom because we saw a move down on Monday and then a reversal from the lows. So all you technical analysts there, have a look at that. But we certainly saw some buying coming into Chinese markets. A pullback on Wednesday. It'll be interesting to see where it opens today on Thursday. I know that Chinese stocks overnight in the US were down, particularly Baba off the back of its earning calls. But, a positive week in, a year that's hasn't started off well. And on the back of, 3 to 4 years, depending on which index you look at, for bad performance in China. A lot of that had to do with quotes or talks or implementations from the government and the CCP and the regulatory bodies about stabilizing the market and trying to improve its performance. Because there is a lot of backlash from foreign investors and domestic investors, and we covered some of that last week. Some of the headlines: President Xi is reported to be planning to meet with China Securities Regulatory Commission, which is the CRC. Just shows you how important stabilizing this market is for them. We saw a couple of the national buying teams state that they were going to come into the market. That led to, a boost in markets. We saw some short selling restrictions come into place. Now, there was talk about short selling restrictions 3 or 4 weeks ago. There are further announcements around that helped shore up the market. If you can't short sell, it certainly alleviates some of the downward pressure on asset prices. I was asked about this during the week on radio, and they asked me, would that affect foreign investors? I said, yeah, maybe. The ability not to short. You want to be able to go both ways, particularly institutionally. But I said that's not their biggest problem. They need to shore up domestic market, and removing or effective restrictions on short selling, I think will be good in the short term. This is part of the announcements was, parts of measures to stabilize the stock market and ensure fairness. And I think it's, part of it's to control capital outflows. And it's a response to the stock market downturn and the economic growth uncertainties that are facing in China. I was just reading off my notes here. We had a new head of securities in place in China. Just shows you, what's happening, the machinations behind it. I'll just read you from Reuters. China has ousted the head of securities watchdog, the official Xinhua news agency said, replacing him with a veteran regulator with a reputation for tough action as policymakers struggle to stabilize the country's stock markets. The cabinet has replaced, and I'm going to get this pronunciation wrong, Yu Hua as chairman of the CSRC, with Wu Qing, who has led the Shanghai Stock Exchange and served as a key deputy in Shanghai's municipal government, Xinhua said on Wednesday. So, movements, it's obviously a priority for the regulators and the government itself, and we'll cover why it's such a priority going forward. A little bit about, Uninvestable and the fallout. The fallout from Evergrande continues, and we saw the implementation of a whitelist. Rumors of a whitelist, which I'll cover also. And of course, we had Baba drop its earnings last night. So there are some of the key headlines, a lot of overarching key headlines, which we'll talk about in this week. Let's begin with the agenda, and let's just talk about the whitelist. So a whitelist was sent out, as you can see in the fourth line there, sent about to 50 lenders, talking about 107 projects in Nanning and 314 in Chongqing. These are whitelisted projects, and we want to ensure that we have lending to complete these projects going forward. So it's an attempt by the regulators and the government to try to shore up some of these projects and to ensure some market stability in them, and also to show Chinese buyers that the government is stepping in, and to give them a surety that, one, that their projects are going to be finished, and two, they're not going to be left in the lurk with an unfinished project. Now, part of this is to continue market stability. If you feel like your project is going to be finished and you're going to have a property at the end of it, well, then you're going to feel more confident about your financial status. Sure, your property might be down in price, but at least it's getting finished. They're trying to shore up consumer and market confidence. What happens is when you have a property market that decreases by 25 to 30%, particularly in China, which is a high savings rate, and people, had built their wealth on the back of properties, when your property market goes down, specifically, let's look at the Japanese case, your assets go down, you're still in debt. What you start to do is you think, okay, I need to pay down my debt more. And in order to pay down your debt, you need to save more money. And by saving more money, you don't spend any money. That leads to further repercussions throughout the economy. No spending means no growth, means businesses aren't growing, aren't employing more, who then spend more, and it's that cycle, or that economic cycle you have in economies going forward. So this is, I guess, in the fallout to Evergrande. I think it wants to shore up to say, look, we're going to protect your properties. I mean, the government in China is in a very, very precarious situation, particularly within Evergrande. If they follow the Hong Kong's ruling, then you've kind of got to liquidate a lot of these assets at cents in the dollar, which would be a fire sale on China's property market, which would lead to further decrease in consumer confidence. If they don't follow the ruling, which I don't think they will, what does that say to foreign investors about the sovereignty of Hong Kong, and how Hong Kong listed stocks can't follow rulings issued by a Hong Kong court? It's a very troublesome period. But I think this has been a pretty good development. So it talks about, a loan has already been extended. The scheme separates project financing from developers' credit risk, focusing on individual project completion and a smooth handover to buyers. There was a reported developer that already defaulted in debt, was included in the whitelist. Developers believe projects meeting authority conditions have a good chance of making the list. I mean, you've got to also meet some condition. So they're trying to shore up the market, in particular around the property market. We have to remember that property has contributed to 25 to 30% of China's GDP over the last couple of decades. And this is an important area to shore up, because if you can shore this up, it may lead to more confidence, which may lead to more investments, which only leads to a greater market. This applies to the stock market, because not only do you have property developers that are listed, but again, consumer confidence is very important. If the consumer in China is confident, if the citizen is confident in China, or at least alleviate some of this lack of confidence that they have, then they're more inclined to spend, and they're more inclined to consume, and they're more inclined to go to restaurants and travel domestically, and do some of that discretionary spending that an economy like China, which is still export driven, is trying to rely on more as it modernizes and becomes a middle income country. If you feel like your property market or the value of some of your biggest assets have stabilized, then you're more inclined to use some of that excess savings to spend. If you spend, companies benefit from it. These companies are listed on the stock market benefits, etc., etc., etc. Some say this is almost too late, but it'll be keen to see how this plays out. And whether any other major developers, the next one is Country Garden. Now remember, most of Evergrande's assets are listed here in the mainland. However, consumer confidence is a very important part of what's going on here. All right, let's take a look at, this notion, and I've highlighted two articles that were written in the last week. One from the South China Morning Post, the SCMP, which is owned by Alibaba, if you didn't know. And the other one was from Bloomberg. And it's on the back of a Financial Times article that I also read about China, or fund managers saying that China was uninvestable. But let's just deal with, I guess, the confidence problem that I've alluded to earlier in this week's episode around Chinese markets. You have a massive outflow of foreign investments. There was an article in last night that I saw flash up on my phone from Bloomberg saying it's this generational shift away from China into India. And the reason, I guess, for that is when you look at broadening a portfolio or making up a portfolio, or a fund manager looks at a portfolio, or an advisor, or whatever it is, you have asset allocation. And part of that asset allocation is towards emerging markets. Now, the two major emerging markets you look at are China and India. And China has certainly been the sole focus of emerging market allocation for the last decade. As you start to get this notion about China being uninvestable, you've seen a massive outflow or a reallocation away from Chinese assets for that emerging market allocation into India, which means you've got to sell down Chinese stocks and you've got to buy Indian ones or Indian funds, etc. So that obviously doesn't assist with the market. The second, I guess, the double whammy is, okay, it's okay if foreigners are investing, if the domestic market, the mainland Chinese, the Chinese citizens are buying their national champions, are buying Didi, are buying Alibaba, are buying Tencent, are buying Meituan, are buying Pinduoduo, are buying SMOC, right? However, what is happening is, because of the volatility of the market and because of the performance of the market, Chinese citizens are spurring Chinese stocks and looking outward or looking to other alternative assets. One of them is gold. So this article by the SCMP talked about a massive outflow or massive record gold buying by Chinese citizens as they look to preserve their wealth and move away from the volatile market that we've seen. And in fairness, a market that has come off for the last 3 to 4 years, depending on what index you look at. So what that means is you have a lack of pool of funds that is being invested in the stock market. The second one, which I'll cover a little bit in more detail, talked about Chinese citizens or Chinese investors moving away funds from local Chinese investments, right, whether they be ETFs or direct stocks, into foreign stock ETFs, okay, which mainly predominantly were the Japanese and the US market. Now, the thing with China is it's a little bit different because you have foreign capital controls, capital outflow controls. It's hard to get your money out of China. In order to buy overseas assets, you can't go and set up an account with Interactive Brokers or E-Trade or whatever it is and buy Microsoft or Google. You have to go through an approved fund manager within China who then has an ETF which you can invest in. So what we've seen as we go through here is you've seen almost $2 billion in January, excluding Hong Kong, into foreign track benchmarks. So that money's got to either come from your savings account or more likely come from selling Chinese assets or Chinese companies and investing them into foreign assets, which creates selling pressure. So you'll see that more than half has been invested in US stocks. An additional $204 million was invested in Japan. And here's the key one. So prices of these domestic ETFs have shot up 40% above the value of their underlying assets. So whenever you have a look at ETFs, and I've put together a really good ETF course for Chinese ETFs and everything, all ETFs, which I hope one day to publish. If you look at ETFs, they have a net asset value. Okay, so an ETF is comprised of multiple assets, multiple stocks, tracking a certain sector or index. You know, when you group them all together and you give a price, it gives a net asset value. You know, it's in value with the underlying assets it's tracking. But when you have a flow of funds, people buying up these assets, the price is trading way above the net asset value. People don't care because they want their money out. In fact, the buying got so much that some put in kind of a limit on how much they were taking per day. In order that, you can see that at the bottom, a fund by China Universal Asset Management Co. tracking the MSCI USI 50 index reached its target of 220 million yuan in a single day. All right, so there was limitations. And you can see most of it's flowed into overseas assets, mainly the NASDAQ 100 and US assets, because it's been performing so well. That's another story. And because the CSI 300 has fallen to a 5-year low, losing more than 7% this year. So it's been the frustration with the lack of growth in their domestic assets. Let me park my money somewhere else. It's been parked in overseas assets in the US, and it's also been parked in other assets such as gold to preserve their wealth. And when I alluded to earlier, yes, it's important to get foreign direct investment back into China, to get EM or emerging market flows back into China. It's also important to shore up your domestic market, because if you can shore up your domestic market, they tend to be longer term holders. They will hold their national champions longer, right? Which creates kind of a floor for the market. And I think that is the key component that regulators have to do. They need to get confidence back of Chinese citizens back into their domestic market. We talked about snowball derivatives last week, and how, there was a quote from one of the investors who was not upset because she got triggered on the snowball derivative, but rather that her market was so crappy compared to the rest of the world. So that's another wall against the Chinese at the moment and its market at the moment, another hurdle they need to overcome. And it's a notion of what is happening, particularly on the mainland. Chinese investors are fleeing their own domestic stocks in looking for better alternative or safer alternatives or less volatile alternatives. And there's a really good quote at the end by Pen Hong, who said, investors are voting with their feet. And that's all there is to say about this trend. Chasing these funds at high premium is risky. This is what we're talking about, the net asset value trading way below the current ETF price. But it's choosing the lesser of two evils. US stocks could see a correction, taking you to ankle deep in losses, but if you bottom fish onshore stocks, you are likely to be neck deep. And that's what's happened over the last 3 years. If you've bottom fished Chinese stocks, you've been hurt. And it brings me to that point, and this was on the back of, and I've just got some notes here that I want to read on the back of this. This was on the back of an article that was printed in the FT, and it looked at some JP Morgan advisors, and it surveyed them, or global asset managers, and 40% of them said that China is uninvestable, right? Now, a lot of people are saying China is real value when you compare it to other markets in the world. I tend to agree with them. That China could have a massive year this year. I think it will, but who knows? And one of the reasons why for the lack of performance is foreign investors have left the Chinese market. Okay, it's just become too hard. And that can be mums and dads around the world who used to have an allocation to the Baidus, to the Alibabas, who've been to the Tencents. We remember during COVID, Wall Street bets, they couldn't get enough of Chinese tech stocks. That's all left. They've left. They've sold down their assets. It's been too hard. And they've moved on to other asset classes. And understandably so when you look at the performance of the S&P 500 and the NASDAQ over that time. We alluded to it earlier. Emerging market managers, or your allocation to emerging markets, has moved to areas such as India, Vietnam, Korea. I don't know if that's an emerging market or anymore. Other areas of Southeast Asia like Thailand, maybe some elements of South America or Africa, and away from what used to be a cornerstone of emerging markets. If you look at a lot of emerging market ETFs, you will find that still is a major portion is invested in China. However, that's come down. That results in selling and buying somewhere else. Selling creates selling pressure. And it comes down to this area of, is China uninvestable? I don't believe so. I still believe it's the most important economy in the world. I still think it's going to be very economically dominant, more dominant than anyone else. However, that notion or that belief has been questioned many times over the last 3 to 4 years. And this notion of China is uninvestable has come up a lot. So I just wanted to analyze why fund managers, external parties, news outlets, media organizations, financial commentary is China uninvestable, why that's coming up more and more often. And the first number one point here is regulatory risk. Okay? And this was triggered particularly when China came down hard on its tech companies in 2021-22, right? Came in, fined Alibaba, scuttled the Alipay IPO, really came down on the organization, kind of forced it to look at breaking up, then came down hard on the gaming companies, then came hard down on Tencent. A lot of this restructuring, the one of two sides, the walled gardens, tracking their data. They believed their tech companies were too big. They wanted more out of them, more social stability, more social responsibility. You then look at the property market. You got to remember this property market, this property collapse was almost government engineered. They came out and said to the developers, you can't be leveraged past this point. That led to the knock-on effect and the domino effect. You look at, they wiped out pretty much the education sector within China a couple of years ago, where they said this higher educational after-school tutoring, etc., which was a massive industry. $billion companies basically wiped them out, right, with one fell swoop. Recently, again, they've re-entered gaming. Restrictions on how much you can game, restrictions on how much you can log in, restrictions on what gaming companies can do. So when you invest in China, there's a lot of regulatory risk, and it's very different to the regulatory risk you face in the US, or other foreign markets. If there's a regulatory risk in the US, you have, we might do this, and then it's got to go through the Senate and the upper house or whatever it is, and it takes years to get done. Whereas in China, advantage and disadvantage of a command economy, you can do it in one fell swoop. Often China brings out big policy, implements it, and then makes thousands of changes as they go along. Difference between the US is they take 3 or 4 or 5 years to bring out a policy. Then they can't make any changes because they're stuck with it, because it's got to go through their houses of government. Whatever is better is up to you. But that is the biggest issue with investing in China, is what is the government going to do on a day-to-day basis, and how is that going to change the fundamentals of my business? The tech companies are a perfect example. They came in, they cracked down on them, and they haven't recovered since. Are they value? I believe they are, not a recommendation. However, everybody's fearing where is the growth, and if they do continue to grow or move into new markets, what will the government do? It's a PR problem that China is facing. That's number one, regulatory risk. The second one is geopolitical risk. You're obviously in a new era of US and China relations, a new era of China and European relations. Last week we talked about, China facing restrictions into EV markets around the world. You look at the semiconductor industry in China, right? How it's been circumvented from getting foreign tech. What restrictions will they face when, one, getting technology into the country, semiconductors, or two, exporting some of their great companies around the world, like their EV companies, right? Like their financial companies, which are, have great services or great products, but will they face restrictions when entering foreign markets? That's the two biggest ones that is limiting, I guess, the asset space or the amount of funds that could be invested in the world's second largest economy. The third one is volatility. No one likes volatility. Some people like volatility, some people don't. But because of the regulatory risk and because of the geopolitical risk, the US could come out and say, we're banning X, Y, and Z. That creates enormous volatility in markets. That makes people think China is uninvestable. And then there's the economic stability, right? The world is worried about its property market. It's worried about its consumer. It's worried maybe about its political structure. And that is creating, again, a hurdle for foreign investors to come into China. It's creating a hurdle for domestic investors. We just looked at that. And if the Chinese market is to recover, if the Chinese market is to go on, they really need to fix what I call is a public relations problem. But the four major reasons why we're starting to talk about why China is uninvestable is regulatory risk, first one, because of the last 2 to 3 years of what has happened. Geopolitical risk, semiconductors is a perfect example of that, right? Volatility and economic stability. The Chinese regulators, the CCP or whoever it is, needs to start fixing these issues, okay? They've intervened. I understand they want to create a fair and open market. I understand some of the reasons for tech regulation. In fact, I applaud some of the reasons for tech regulation, okay? Maybe tech is getting too big at some point. But, however, this is making investors nervous about owning Chinese stocks. Another one of the geopolitical risk is when you had the threat of delisting US assets, Chinese stocks listed in the US. No one wants to deal with that. It's too hard. I'll sell it, move on. These are some of the issues that they need to fix, along with some of the economic issues that are occurring. All right, let's talk about Geely, which is, depending on what you read, the fourth or fifth biggest EV car maker in China. And there was an article or some news around them launching satellites into low orbit. And the reason for the satellites into low orbit, which most, EV makers or car companies will have to do in order to get autonomous driving, is for autonomous driving. So you can see there high precision positioning for autonomous vehicles and connectivity for consumer electronics. Connect to the satellite, you can do more things, etc. Remember, the EV and what China has made the EV, it's a whole new experience, right? Your car is a whole new experience for you. You can do a lot more within there. It's a software program with wheels. So I thought this was interesting. The thing I wanted to point out is, we talk about all the doldrums that are happening within China. There's a lot of innovation going on. There's a lot of moving towards the future that is going on. And this is part of China's 5-year plan. The integration of satellite networks for communications, remote sensing and navigation. I often talk about the space race. There's a new space race between China and the US, and that's to get as many satellites in the air. There's a satellite traffic problem we've got now. This kind of rivals really Geely. Not many of the other major car companies within China have done or have been as advanced as Geely has been in launching low Earth orbit satellites. This is their second dispatch. They want 72 satellites in orbit by 2025, and therefore 240 is the eventual goal to, ensure autonomous vehicles are happening. A little other point, you were talking about the 5-year plan. China's space assets now are over 400 satellites in space, including those that are commercially owned and run by the government. In terms of EV or car companies, Geely's kind of second to Tesla in launching low orbit satellites. Stock price has done okay, but again, remember, China's EV market is in a price war, and they're facing restrictions in traveling overseas or selling their vehicles overseas. Not much individual stock analysis this week. We didn't get to Barber only because I'm so busy, but I promise we'll extend these shows a little bit more. Still kind of playing with what we do, what we say, how we go about it. If you got any feedback, let me know. Let me know in the comment section. Thanks for tuning in for the second episode. If you haven't subscribed, please subscribe. If you got any ideas, let me know. And as always, good luck with your investing. Thanks, guys.